by investing in single family, you are potentially risking all your other assets and putting not only your own personal credit on the line, but you're exposing yourself to legal exposure from a liability standpoint. There's really two ways that gurus will say, hey, here's how you protect yourself, right? This is why I had to ask for permission, because a single family, the two ways that gurus say, well, yeah, that's normal, everybody does it, but this is what we do. One is as soon as you close on the asset, we'll do a hot swap and we'll put that asset in an LLC, right? Well, then if it gets sued, then it's just everything within that LLC that they can take, so that you're limited to the equity in that property. But because you personally guaranteed the loan and you got the loan in your own name, if the lender finds out about that, they can exercise, because you sold it to an LLC.
They can exercise the right to call the loan.
They can exercise the right to call the loan.
I am Christina Suter, and this is the Real Estate Breakthrough Show, where we talk about the reality of real estate, the mindset you need in order to face the reality of what it is, and tips and tricks to get you moving forward in investing. I am your host, Christina Suter. I have Patrick Gimes with me, investonmainstreet.com. So I'm going to do my usual, guys. I'm going to share my screen and you're going to get a quick look at Patrick's bio. So you can see Patrick's a real person. He actually has a website, obviously, because he has a website that makes him a real person, right, Patrick? In this day and age.
I'm not a robot. Sure.
Of course, you're not a robot, right? You have a website.
Don't exist.
And I don't know, Patrick, but it looks like you have more hair in this picture. I'm just saying.
Occasionally I put on the wig, but
we were teasing earlier when we got started, guys. We're just anchoring back to a conversation we started this with that you guys did not get to hear because we did not record that. All right, shortest bio. Here we go. Patrick Gimes is the founder and CEO of investonmainstreet.com. That is literally investonmainstreet.com. That is also his website, a private equity firm with a mission to enhance busy professionals' quality of life by providing tax shielded and inflation hedged passive investments. Super important in today's market, isn't it, Patrick?
Absolutely.
Yep. He has over 14 years of experience in active real estate investment, purchasing distressed assets, renovation, and stabilizing for long-term cash flow. His company's 300 million plus portfolio includes 3,000 plus units in multifamily apartment communities in the emerging markets across Texas and the southeastern United States. Patrick co-authored an amazing Amazon #1 best-selling book, Persistence, Pivots, and Game Changers, and writes articles on investing in commercial real estate for Forbes and Inman author. Patrick holds a bachelor's in engineering and a master's of science in engineering and an MBA. And here is your Forbes page since 2002, but you got some good articles out there.
Yeah, I've got, I don't know, probably half a dozen, something like that, articles published on Forbes at this point.
So once you give us a quick background on how you went from engineering to real estate, you're going to actually talk a little bit about, I think, one of the articles that you recently put out, because I'm like, educate, right? So tell us, how did you get from engineering to real estate?
Well, Christina, first I want to say it's an honor to be on your show. I remember when I was grinding away at single family investing, doing the old buy and renovate and hold. I was attending your multifamily investing in Pasadena. And I was just like, wow, these people really have it together. I need to trade up into these larger, more sophisticated assets. And it's really excited to be here on the other side of it and have built out a great business. And I appreciate all your help along the way.
Yeah, you've moved very quickly. And I appreciate the determination you've shown in being able to take the engineering background. I always find it interesting where people start. I don't do the bio just because it's the thing to do. I do the bio because where people start often defines their success when they take that same skill set and move into real estate. And for me, I feel like there's a very clear line between your engineering and your thinking and your capacity to work out the numbers to then go from single family to multifamily. And that engineering is part of that journey.
You know, I was just having that conversation this last weekend. I think for every engineer that makes it, there's also one that never gets over the analysis paralysis.
Sure.
Because I spent 2.5 years just underwriting and learning the multifamily business before I ever pulled the trigger. Nice. But to answer your question, so back in 2006, I started my engineering career in mechanical engineering, and that time I was good friends. I became quickly good friends with one of the owners who gave me some advice that stuck with me. And that was, sure, this engineering stuff's cognitively rewarding and a lot of fun, but it's not going to afford yourself and your family the future that you want. And you need to buy as much real estate as you can, as quick as you can. And he wished he had done more when he was younger. And so sure enough, I saved up every penny. And that's why I've been investing in real estate for 2 years less than I've been an engineer. But the first half was painful. I'll tell you why, because I got into what I considered to be great investments, because back then, the market was never going to go down. It was just skyrocketing forward.
Yep.
So I did what every responsible college grad does. I buy something, I leverage it as much as I can. And American dream. I personally guaranteed all those loans, and at 8, 9, 10, everything came crashing. And so I got to experience what it's like to, I was able to escape bankruptcy by going through foreclosure and negotiating debt forgiveness. But I was able to experience what losing is like. And even the IRS took the debt forgiveness and then tacked it onto my income.
Yes, they did.
So I was even paying for,
you're paying taxes on your debt forgiveness. Yes. You're paying taxes on your losses.
Yes.
Yes.
Crazy. So, and that caused me to, it was very humbling, and fortunately was very early in my career. And so I as I was crawling out of that hole, they say, if you don't lose any money, because if you lose half of your money, then it takes 100% gain to get back to just break even. Well, how about if you lose all of it? So it's an infinite return, engineering. So I was crawling out of that. I went back into high tech, got 2 master's degrees in business and engineering. And I started then getting bonuses again, to the point where I'm like, I need to get back into real estate, still had that advice. And so then that's when I started in single family.
Okay.
And that's what brought me into that.
And then you were investing in single family, and then you said earlier, like you went to meetings, mine being one of them. Thank you, Patrick. It's one of the joys of interviewing you, is like, I remember when Patrick was a younger man.
We came up with our company name at your meetup.
Oh, really?
Yeah.
Oh, that makes me so happy. I cannot tell you. I mean, the purpose of my meetups is to educate and network. It is to help to make investors be successful. We're in the process of reworking our meeting with Bronson, the multifamily meeting I share with Bronson. We're in the process of reworking it to try to find even more ways to empower the people that come to our meetings, to encourage them to move along in their investing. And so if you can do that at the meeting, that's part of the purpose of that meeting. That's part of the purpose of that platform. That is the joy that it brings me and Bronson, is that capacity to pay it forward, to make others successful, to have more people in the game. There's 80% of the world's wealth is in some version of real estate. There's a lot of freaking wealth available in real estate, baby. There's no reason why there shouldn't be a whole bunch of us playing this game and educating each other and working with each other and keeping each other safe. Like, I'm currently revamping my own work, which we talked about. I'm revamping my own work, and I've called 2 people that I know, and they're like, yeah, let's have lunch. Let me educate you. Let me tell you what the inside's like. Let me show you the way. Let me show you the way. I'm like, good work gets you good work, right? I support them in their work, and they support me in mine when I'm busy changing. So it makes me happy. Did I get that? It makes me happy. Okay. I've taken way too much time with that. So moving on to, then you went from single family to multifamily, but you did it aggressively and very thoughtfully. So talk about how you doubled down into multifamily.
Well, so the challenge is that single family was working. I was successful-ish. You think about the pace in which you can grow at single family is a completely non-exponential curve compared to multifamily. But I was also sacrificing a lot of time with my family, friends, and hobbies because I was moonlighting it with engineering, and it didn't seem like I was going to be able to outpace my engineering income on that journey. And then when I met my wife, that's when it all, came crap. I was like, well, put it on pause, because I want to marry this one and I can't do both. So she was there for my very last single family closing. And then when we came back to it, we got married in California and then Beijing. And then when we came back to it, I was like, hey, I had done a bunch of research. I'm kind of one of those just analyzer education. My dad has 3 PhDs. So we just constantly learning. So I had arrived at multifamily through the high risk adjusted returns, inflation, and scalability, as well as the property management, all these reasons that are there, everybody knows. I'd arrived at it. It's like, this is what I want to do. And she's like, well, what do you mean financial freedom? What do you mean, passive income being from China? So that was a journey. So it took a while.
There
And,
she is.
Mm-hmm.
Yes.
Yeah.
Just thought I'd show her because she's so beautiful.
Yeah,
She's very sweet. She's very good at investor education and investor relations. She's just very generous of heart and a very ethical person. I just love her.
Yeah, she's got 70 some videos now. You can subscribe to her on her website, 1 Minute to Cash Flow. Wake up every morning to, hi, this is Shua. Let's talk about net operating income, right? And it's just so great. So nice. I'm very impressed. Yeah. So we have lots of people subscribing to 1 minute in little chunks, via text or email on our site to that. Waking up to Shua in the morning, little tidbits. Mm-hmm. So we hit it hard, and it took about 2.5 years of just meeting different people, picking up little courses, picking up books, going to conferences. Each were kind of little lamps, like, hey, this kind of shed some light here, it's kind of shed some light there. And then I started getting some masterminds where they would review my deal analysis, and it took about 2.5 years before finally I brought a deal to an individual who had experience. And I said, hey, what about this and what about that? And eventually he was like, well, let's work on one together. And after that one, all in, I didn't know what I was getting out of it. I didn't know what percentage of the partnership I was going to have. Didn't care. It was the first time a deal was underwritten, analyzed conservatively, and I got it. It all came together. I had to trust and know like with the team, and just went for it. And it became a partnership after that.
And you've done an amazing job with it. I mean, now you've got 300 million and 3,000 units. So I wish I had lots more time to understand your journey, because I think for newer investors, when they go, well, how do you go from a single family to a multifamily? How does that journey work? Like your story is a perfect example. You spent 2.5 years educating yourself. 2.5 years developing your network, education and networking. And my little, mantra, education and networking. 2.5 years educating yourself, 2.5 years, developing your network, 2.5 years being connected to people who were experts in the field until something actually showed up in reality. And it really is that commitment. I mean, people are like, how do you do it? Oh, it's so complex. No, it's not. It's a commitment to showing up and showing up in the right circle of people. Right? Choosing the circle you're going to continue to work in, and you develop longer term relationships with these people. And then they go, hey, I know, like, and trust you. I see that you're committed to this. You're doing your due diligence to find and acquire deals. And when a deal shows up that's a live one, and you've got a strong network, you're capable of going, yeah, I'm going to take my first multi-unit down. Yeah. And there's always this void, because I watch people do it over and over and over again at my meetings, right? There's this void period. It's a year, it's a year and a half, it's 2 years. There's this void where it's like, oh man, I've been pounding on this concept for forever, Christina. When am I going to finally take a deal down? Oh, I'm so nervous. I don't know what I'm doing. I'm like, well, trust me, once you get a deal, you're going to learn what you need to do very fast. Yes, educate yourself beforehand and be prepared for the experience, right? But it's the marrying the two that created the success. I just can't say it enough times, right? Because, I say it at every meeting. People are like, oh, what do you need to be successful? And I'll say, oh, you need money. No, you need education and you need a network, and the two and the work, and we work the work, and the two will come together and you will grow. I mean, look at you, Patrick, you're the perfect example.
Yeah, I couldn't have put it better myself. I mean, I look now at new people saying, hey, I just learned about this. I'm going to conferences. They're like, how do I get into it? I'm like, it's a journey, right? And I want to wait. I want to wait and see what their attrition level is, because there's at least a 90% dropout right in this space. And
there is.
I've never been scared of working hard. Work full time at machine design, automation, and robotics. Get 2 master's degrees at the same time while traveling. I mean, I've never and buying single family. I was like, I've never been shy of hard work, but it just takes a lot of time. And I think that I'm looking for people to show up just exactly like you're saying for a while, and get and see how they're doing out there, what they're doing out there, and get a feel for how committed they are, because these are marriages. right?
That's
And
right.
it takes, you can't go all the way on the first date, right?
Please don't.
Yeah,
It's best if you don't.
yeah, you've gotta find people that you've built this trust with over time before you want to join up.
You said it perfectly, Patrick. And
Mhm.
I want to tell my editor, like, cut this piece out and then put it everywhere. Like, how do you get successful in real estate? There you go. There it is in 10 minutes. Okay, Patrick, let's jump to the educational segment. So you just
Sure.
wrote an article for Forbes, and it specifically trashes single family. So I'm preparing people for this. It trashes single family, and
Right.
it focuses on why multi-unit is your baby, why you love it. So educate us.
Well, so well, first of all, I don't necessarily trash it, although I did say
Okay.
to you, are you okay if I do? Because
Okay. It's a
yeah,
joke. People, hopefully my listeners are used to my sarcasm. So yes,
yeah,
single
yeah.
family works
Mhm.
and multifamily works in some ways better, but not for everybody. So how about
Yeah,
that?
and so when I was talking to this with Forbes, it was hard for them to grasp the concepts, because anybody that's thinking of single family, they're thinking of the TV, fix and flip shows, right? And
Right, right.
getting instantaneous checks, and they want to, but what they don't understand is the risk. And so that when I was writing this article, I submitted it. They're like, well, this, it took actually broke into two articles. So there's actually one on asset protection,
Okay.
single family versus multi, and then so two came out on the same day, and that's really strange because they were like, well, these are two different concepts, it's paramount, and let's link them to each other. So how it works really is, when you talk about single family, people don't realize that, especially when you're starting out, it's a lot riskier and amongst the slowest ways to get involved in real estate. And so me being somebody that completely understands that, yeah, so there's accelerating retirement, and then the next one is asset protection. Yeah, so they put them out on the same day because we wrote them, they paired one into two.
Yeah.
But yeah, so in those, you got to think about, for example, there's both a financial and a legal side, and I'll try and be brief because I know we don't have too much time.
We'll work it out.
But on the financial side, or sorry, let's try it on the financial side. Just like me back in 2007, when I had to personally guarantee those loans. Why? Well, because single family properties are not profitable enough or safe enough for lenders to lend on them on their own without somebody else coming and putting their net worth and their credit on the line. They need a personal guarantee, a personal guarantor, right? And so with and while single family investors think, oh, well, that's normal, that's just how it is, and but no, in commercial multifamily, we buy income producing apartment communities, 100-unit plus, that are cash flowing on day one, stabilized, very low risk businesses that even in downturns tend to, and we address this tend to actually do better, because people tend to downsize into our workforce housing multifamily. So the lenders, oh, you know what? Forget about you. Well, first, I need to know that you have experience and
Right.
you have the net worth and liquidity. I need to know that you can carry this business forward, but you can just be the CEO of the company, right? But in the end of the day, if the company defaults on our loan, we'll just take the company.
That's right.
Because it's a stabilized income producing asset. I don't need your personal, Mr. CEO, credit. You don't need to personally guarantee it. We're going to come after all your assets and then make you pay taxes on our losses. No, we'll just take the company. And so the idea is, you don't realize is that people with net worth that have done well for themselves, when they go, oh, I want to be a fix and flipper, they're maybe signing on a hard money loan or even a conventional loan. You're still putting yourself out there, not only from the financial side in that way, but also on a legal side. And the legal side is because if somebody trips and falls on your property, whether it be your tenant or your tenant throws a party, or somebody, their grandmother trips, or somebody gets drunk, falls off a deck and injures themselves potentially fatally. Well, because you bought it in your own name and you're on the title for it, so you're personally liable for that. So they can then, they'll then look up to see who owns it, figure out if you're the owner. They can then search for all the other ones that you own, and then they can kind of add up your assets, and the attorney can say, well, it's worth it to sue this person.
Right.
Right. And so because you've done it in your own name, now there's really two ways. So it's actually by investing in single family, you are potentially risking all your other assets and putting not only your own personal credit on the line, but you're exposing yourself to legal exposure from a liability standpoint. There's really two ways that gurus will say, hey, here's how you protect yourself, right? This is why I had to ask for permission, because a single family, the two ways that gurus say, well, yeah, that's normal, everybody does it, but this is what we do. One is as soon as you close on the asset, we'll do a hot swap and we'll put that asset in an LLC, right? Well, then if it gets sued, then it's just everything within that LLC that they can take, so that you're limited to the equity in that property. But because you personally guaranteed the loan and you got the loan in your own name, if the lender finds out about that, they can exercise, because you sold it to an LLC.
They can exercise the right to call the loan.
They can exercise the right to call the loan. When would they do that? Well, they wouldn't exercise the right to call the loan if everything's fine, the bills are being paid. But say there's a downturn, a shift in the market, or they get audited, and then all of a sudden it's advantageous for them to call the loan because they can probably take the property. It's going to be harder for you to get a loan somewhere else, but it's perhaps not going to be when you want it, right? And so if they call the loan, hopefully you can secure other financing. But what if that happens today when interest rates are rising and you had locked in a 2%, 3%, 4% interest loan, and now you're looking at 6, 7, and 8, you're going to try and refinance it in current conditions at that time, or give up the property because they can go through foreclosure. So you're really playing dice. And when I wake up in the morning now, after I've been through what I've been through, I want to look in the rearview mirror every morning, and I want my family to know we're safe. We're not gambling on the market with our retirement, right? So they say that. They say, we'll do a hot swap, right, with the LLC. The other way they say is, oh, you know what? Just keep it in your own name, right?
And having an umbrella.
But let's put a big fatty insurance policy on it.
Yeah.
I have that. So I totally get it. I'm trading those single families that I've built into multifamilies now. But so before, when you had it in your own name, the attorney would look up and see all the assets you have, your net worth, and maybe the frivolous attorney would come after you. Now they see that it's not in an LLC, but they also can come after you and find out you have an insurance policy. Well, that's another pot of gold for them. Even if you don't have a high net worth and a lot of equity to your name and things they can come after, they now have a pot of gold that is the limit of the liability insurance policy that you have, right? So, which means you're going to go to court. Will you win? Maybe you'll win, which means you're still paying the legal fees. So you lose. Maybe you'll lose, or maybe you'll lose, and then the insurance will pay it all, right? No, they don't pay for the legal fees.
So you're still paying the legal fees.
You're still paying for the legal fees, but that's not going to happen because your insurance policy is going to settle.
Yeah.
So, and then not only, right? So you're going to be paying for legal fees until it settles. And then at that point, you're going to be uninsurable. It's going to be much harder for you to get insurance. Insurance is going to be much more expensive. It's not a stabilized business. You're rolling the dice with single family. Now, in multifamily, you're a passive investor in multifamily. I mean, do you have any comments? It seems like you're tracking with me, right, Christina?
Oh, I'm totally tracking with you. I'm busy thinking little subtleties like, you know, in my history, like when I was a brand new investor, that's when they go, oh, well, really, we want you to have your first, your second, your third, your fourth home in your name. We want to be able to track you because really we're considering it more of like a secondary property for you. And at that point, that's when you're under these jurisdictions that you're talking about, where the bank kind of forces your hand into having it in your name because the loan's in your name because you want to have a loan blah, 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 match with. Then later, as you become like later, when I've had more homes, then I can go, oh, I can put it in my LLC from the beginning and the LLC can get the loan. But I still want my LLC to be a two-person LLC. That doesn't solve the problem by itself. You still want to have a two-person LLC because otherwise, if you do get sued, a single-person LLC can be disregarded. And now they're back to getting access to you. Yeah. Right. So you want a two-person LLC. Yeah. And then you've got the insurance policy.
And I addressed two things in the article about that. Sure. So what you said is, yes, when you're starting out, which is what I'm speaking to, those starting out.
That's right.
There's a bridge which you're personally guaranteeing, and you're staking all your net worth, all of it. You're exposing yourself
On each
legally.
one.
You're exposing yourself financially. It's like putting, okay, stack on green 22 because it's normal in single family, until you get to the point where you have enough net worth and enough properties where you can put them all into one LLC. That protects your personal assets from the liability claim, potentially.
If it's a
Because
dual member LLC, yep.
somebody trips and falls,
Yep.
right? Then if you have a partnership, two-member LLC, if somebody trips and falls, you're protected. But again,
You're still sued. Go ahead.
it's all the equity in that LLC.
Yeah.
So it's all your eggs in that one basket. So when that frivolous attorney looks up and says, okay, what else does this LLC own? Oh, this LLC owns all these different assets. Pot of gold for them. They're going to come and look and see. And it's just, unfortunately, this happens all the time. And I know people that this has happened to, and especially in downturns, right? Especially when they know that you're hurting. And so what you're doing is you're going from saying, okay, here, all my eggs are in this, literally at my entire house, everything is in this basket of a couple single families, to now, okay, I'm going to put all that I've earned in real estate into one basket and hope that doesn't get sued. But right?
Yeah, you don't put it into one basket, you put it into two. But yes, and then you start dividing based upon your total net worth. So yes, there's a way to manage that, but you're still saying, hey, I'm taking half of my net worth and it's exposed, or a third of this is exposed, or all the assets I have in Tennessee were all in one LLC. So I had a multi-unit and some fourplexes that were all in one LLC, all in Tennessee. So that whole chunk of my net worth was specifically in this one Tennessee-based LLC. That LLC is now liable. So I could trip and fall in one of my 4 units. They have access to my multi-unit. Right? That's your point, right? So they have access to that whole basket.
And that's called cross-collateralization. And that's what took down large real estate empires. It took down mom and pop's retirement. And it took down those engineers trying to make it good.
Yes, you're speaking from, the point is you're speaking from personal experience, right? I mean, this isn't like, gee, I'm afraid. This is what happened to me was because I was personally on these loans. This is the conversation I had with the banks as I was actually trying to settle these things.
Yeah.
Right. And that's what I discovered was my vulnerability, right? Your exposure. Go ahead.
And tradition, because most investors think real estate is single family, they don't know any different.
Yes.
Gurus are saying, well, that's just the way it is. It's normal. Take a blind eye to it, or just go through, roll the dice. But I'm telling you, there's a completely different way. And through the 15, 20 years, I've found little lamps and books and things that have led me down a path. What if I said that you could invest in a multi-family syndication, right? And where we haven't addressed how specifics on how much more tax advantage they are and how stable they are over single family. But if I said you could invest passively, you don't have to wake up, worry about tenants, toilets, and trash. You also can invest into a subscription in a multifamily that gives you all the same tax advantages, potentially even more than a single family. And what if I told you that every single investment you made in a multifamily was protected in its own LLC, free from liability concerns? And what if I told you that every investment in a multifamily syndication, you didn't have to sign for personally, you didn't have to personally guarantee. Your limit of exposure from a financial and legal perspective is limited to how much you've invested into it. Again, people will invest in Apple. Well, maybe they'll lose it all, but that's the worst case. But with single family, the worst case keeps going. But with multifamily, it's just like investing in Apple, but you get the tax advantages. You're not paying taxes traditionally on those distributions. You don't have to worry about the financial and the legal obligation. Every single one of your investments are standalone on their own islands. So you have a diversified portfolio, not just a building down the road from you here and another building down the road from you here, that you've been sacrificing time from your family, friends, and hobbies to buy, flip, find, renovate, but through the emerging markets in the southeastern states and Texas, where everybody's moving to, where we have on-site managers that look after it daily, report to you with issues, area and regional managers that are doing all the heavy lifting, people with sophisticated outfits with decades experience. So you can wake up in the morning and just get an email from me. This is how much you made, and this is, where we're going, right?
Right. I love it, Patrick. That was, I love that. No, one of the reasons why I love it is not because it was so well spoken. That's true. But the other reason why I love it is because it's so rarely spoken from a liability point of view. Mm-hmm. That's not, at most people, when they talk about syndications, it's like, well, what's the advantage of syndications? Oh, it allows you diversification into markets that you're not expert in. It saves you time, right? Because now you don't have to be running 1/32 of a mobile home park yourself. You don't have to invest the time. You have somebody else investing the time and the expertise. So you protect it on the expertise level. You don't have to be an expert. You're protected on the time level where somebody else is investing the time. I love your whole conversation about, and you're protected on the liability front. Mm-hmm. Like, I don't hear that conversation very often. Like, I'm going to start, can I steal that? Yeah. I'm literally going to steal that because
you can take my Forbes article and just rewrite it for yourself and get it out there. Because I'm a believer in this, because I don't want it for people, and even Forbes didn't believe it per se. I had the content strategists and the editors and the proofers were all like, we need a reference for that, for this, for that, for this, but we got to take this out because we can't substantiate that. I'm like, nope, every single word of this is going in. Here's every single reference, because it's not talked about. Right?
No, it's not talked about.
The blind eye to this.
Right. That's right. That is correct.
Yeah.
Yeah. I love it. I told you to educate us, and look what you did. You educated us. That was perfect on an area that isn't covered very often. So I'm just going back to the Forbes page here for a minute so people can see it's easy to access. Like, you just type in I literally just typed in your name, Patrick Gimes, and Forbes, and this is what showed up was your
author page.
Author page.
Yeah.
I was gonna say contributors page, but author page. I love that. Okay, so the next piece is okay, do you have a hard stop, by the way?
I'm fine.
Okay, so the next piece is, in today's market conditions, what are you doing to adjust for that?
Well, so somebody who has come through a downturn really hard, came out, that'll change somebody forever. So in 2006, when everybody said, market's never going to go down, buy as much as you can, as quick as you can, right? Yeah. Every year of my life, I'm imagining it as that bubble. And I'm imagining that, okay, what happens if next year is the year that this happens again? And because now I'm tuned into the data, right? I'm looking at different markets under that perspective. So I've been analyzing deals with assumptions, assuming that we're going to go through another major downturn.
Okay.
Now that drives me into markets such as those in Houston, where they just barely leveled off and started going up again. Those markets have long-term attrition through downturns. They have diversified employment that is recession resilient, and into the type of assets which are sort of that mid B, so we call it blue collar, dirty white collar, existing construction, large apartment buildings, not in the prime urban areas, but in the areas that traditionally get busy in recession. So now that said, right, when the right markets, in the right assets, in the right locations, right now we're underwriting like we always have been, very low leverage. For example, our current deal in Atlanta, 284 units, we're doing a 70% loan to value, which means 30% down. Plus we're raising enough capital for improvements, raising capital for closing costs, and we're raising an extra $1 million in just a savings account, which we always do, which is 6 months worth in expenses.
Oh, so good. I've seen deals go down because of a $250,000 unexpected expense. And I just was talking with a guy the other day, and they had a $400,000 extra expense, but because they had the large cushion. Yeah. Sorry, I interrupted your thinking.
No problem.
They were able to absorb it without the project falling apart. I've seen a project fall apart based on just a $250,000 expense. So $250,000 expense. Go ahead, Patrick. You were saying so 30% plus your pieces.
Yeah, 30% plus all of that. We're at like a 64% loan to value or 36% down payment, plus the cushion we have, $1 million. So what does that mean? That means we have a 75% break-even occupancy. That means we're buying on day one, it's cash flowing.
Mhm.
We're above 90% occupancy now. In our assets, they trend closer to 95. It drops down to 90, 85, 80, we're fine. In fact, in the downturns that we've seen, be it our workforce housing apartment buildings have only dropped into the 80s. So that tends to be where people move to in downturns out of their single family homes, luxury condos and high rises into these. So
Yes.
our break-even index is lower than the trends that we've seen. So what are we going to do if this takes a big hit, right? We're going to ride it out. We're going to continue to cash flow, which means we've locked in long-term debt.
Mhm.
We never go below 5 years where we're capping interest rates.
Nice. Nice.
Yeah. And what happens if a tornado comes through and, which has happened to one of my partners, not me, and takes out maybe one or two of the buildings. Typically our apartment communities have about 11 buildings and something like that. But what happens? Well, we've got $1 million. We're not going to our investors saying, hey, we need more money.
Right.
We're saying we've got $1 million. So we're first in line to rebuild, right? And we've got insurance policies.
Right.
Insurance policies that are not only replacement costs, but also loss of rents. So on the other side of it, we have the funds to float to be first in line to rebuild. On the other side of it, it's traditionally a huge win for our investors because now they have new buildings and they've got refunded for 100% occupancy. It wasn't 100% occupied before then, but we'll get, so traditionally it makes up for, it actually turns out to be a win. So while we're not going to get rich tomorrow, like I was trying to do in 2007, I was trying to slide my thing over and turns out I was speculating. I wasn't investing.
That's right.
Right.
Yeah.
I am fortifying the shell of the tortoise, the turtle in the hare, right? I am fortifying the shell.
Right.
I'm going to make it there. Right. And I'm not going to be, riding the curve and worrying and taking naps because I'm sprinting, but we're going to make it there. So it's a bigger shell to carry, but your capital is preserved. And so in today's economic climate, we're underwriting the exact same way, right? We're underwriting assuming that prices are actually going to go down, not up. And that's called cap rate inflation.
Mm-hmm.
We're actually always assuming that way. We're assuming interest rates are going to go up, right? We're always assuming that way. In fact, we buy properties where we're undermanaged. So the only appreciation we assume is what we work for to bring them up to market, right?
Okay.
We don't assume the market's going like that.
Right.
And from an inflationary perspective, we're staying away from the sort of in multifamily, we call it the A, which is your double A or, new construction, luxury stuff, all the way to B and C, workforce housing, all the way down to the D class,
Right.
which are the most challenging and oftentimes income is very challenging. So what you want to do in this inflationary environment is you want to stay away from those. Yeah. And the reason why is in our sort of white collar kind of and blue collar, little bit higher end apartments, not the A class, but the price of toothpaste or $1 in gas doesn't directly affect their quality of life to an extent that it does if $1 extra on gas on the lower income side does. Right. So their disposable income is much smaller. So it can adversely affect their ability to pay rents. And so we've always been, and on the other side, on the A class, if there's a market downturn, they're the first to leave.
They're first to empty. Yeah.
We've always been in that B and C class style, which gives us some built-in insulation. And even during COVID, we continue to distribute because those are the individuals that have the ability to work from home oftentimes, right? Yeah. And through vertically managing, we were able to be the ones knocking on their door. So that's my strategy. And I couldn't answer what we're doing moving forward without also saying what we've been doing, planning for this day to happen. And so our underwriting has shifted slightly. Our interest rates are they're floaters now, but we're actually buying a cap. We're actually buying a cap on that. Yeah. Where those caps last year were like 300, 400,000. They're like 1.2 million now. but we're okay with
That's
that.
the unexpected $400,000 I was talking about, was
Yeah.
buying that cap. That's
There it is.
correct. That's
Yeah.
right.
And these numbers seem big, but we have, they're actually not. We have not had trouble. It's a $22 million raise we're raising right now. We don't have any trouble with our investors coming to the table and investing into our deals. And we're more than happy to lower the projected return slightly to build in a safety net of reserves and interest rate caps and pay for the right insurance and project very conservative, because we want to meet those projections even in the downturn.
And the interest rate cap is just one of many different ways of being able to manage something like this. And I love that you bring that up, because again, as I ask this question, I don't know how many people are going to be able to point out, like, one of your strategies is buying an interest rate cap so that you have control over where the loan goes as we head into potentially, they keep saying potentially stagflation. I saw it today on the Wall Street Journal. Yellen's going, as we head into potentially stagflation. I'm like, we're already there. Come on, like, really? You've looked at it, we're already in stagflation. Okay, moving on beyond my rant. But the point is that they won't claim that we're there, right? But if you look at the numbers, you look at our GDP, you look at our inflation rate, we're already technically in stagflation. So, but that's another topic for another FIBI meeting down the road. But the point is that one of the ways that you manage that as a pure skill is being able to buy the interest rate cap on the loans that you're securing. And I know that you said you were adjusting your exit cap rate assumptions.
Yes. Well, actually, we kept them similar to what they were before. We have 10
Okay.
to 20% basis points a year, which
Oh.
is still what people are underwriting to today in this climate. But again, we were assuming that this was happening last year.
So you've already had it built in.
And the year before, we were assuming that it was going to happen in the next year. But we want to make our money because we're working for it by improving the property, not hoping for the market to grow.
Right. And then I always prefer one, I like to think of it as multiple forms of appreciation or multiple forms of return. The one that you're controlling and that you're counting on is the one that you're creating. And oh, by the way, we might also have market appreciation. We might actually have higher, might account for higher rent increases, might get higher rent increases than what you're accounting for. Because a lot of people, go to 3%, but then we've seen 16% rent increases across the United States in the last year. Nobody underwrote to 16%, as far as I could tell, right? So there was this extra appreciation on these properties in the past. Obviously, everything is changing now moving forward. There's this extra appreciation of just taking a property that was underperforming and making it performing to market rents. Oh, by the way, market rents have now gone up by a good 8%, but you assume a 3% increase. So now you actually have gone beyond your projections because of your conservative underwriting.
Mm-hmm. Yeah. And I wrote a whole article on how multifamily syndication is a hedge against inflation on Forbes. And that was another journey, right, of bringing the Forbes guys up to what all those meant. But we're hedged in that environment because our rents grow, our income is much greater than our expenses. Our expenses grow, but at a smaller rate than our rents. And so oftentimes it can be a win for us.
Yes, and especially with the housing shortage that we're facing, I don't even think in this environment of stagflation that we're going to be seeing aggressive decreases in rents.
Exactly.
Saying stagflation actually, if anything, might increase your rents, not decrease your rents, even though GDP is going down. So, exactly. And I'm standing firmly on that we're seeing stagflation. But I started suggesting that 6 months ago, and people were like, "Why would we see stagflation?" I'm like, "Well, So, again, I'll reserve that for another time." Okay. One of our last questions.
Okay.
Given that real estate is a marathon, it is not a get rich quick. It is something that takes time and effort and commitment to grow in. Why use real estate to break through to your financial freedom?
Well, I guess I would look at it a couple different ways. Supposedly I'm there, right? I actually last week at the Dealmaker Live in Dallas, I was given by Michael Blanca a big medallion that says financial freedom. So I have a financial freedom award.
Congratulations.
Yeah. So But if this was it and this was financial freedom, my wife would probably kill me because, in China, you work until you die, or you work until the government says to stop. And so I'm a hard worker, so I don't know if I'll ever get there. So traditionally, individuals come to me. I've spoken to thousands of investors, and they're thinking they have to become active. What is my time requirement? And so if I think about using real estate to get financial freedom, that doesn't mean you have to go trade your family, friends, and hobbies time. That means you can also invest passively in direct real estate, right? And so why use real estate to get to financial freedom? It's because, over time, it's the high risk adjusted return. It gives you better tax advantages and appreciation while you're at it. Instead of buying an annuity in retirement that completely disappears and doesn't allow you to leave something to your heirs, it'll allow you to get to retirement and then invest in something that cash flows, where your cash flow grows and your appreciation grows, and you can 1031 forward until you pass that on. And so, of course, in my world, I'm heavily weighted in real estate. I think everybody needs a balanced portfolio. On my website, there's an investor guide that says the ultra wealthy actually have about half in business equity and real estate, half of all their net worth in business equity. That's less than like 5 or 10% in the poor middle class area. Right. And so you should have a balanced portfolio. But unfortunately, the way that the financial IQ is in America is that they listen to what their grandfather said, what their employer is saying, and that's get a financial advisor, or if you've got to that point, or just trust in the 401k.
Yeah.
Right.
Right. Yep. Trust in the pension plan, trust in the 401k and the advices we have on the 401k. Yep.
Which, if you choose to do that, you'll work until work with inflation hedged and with market exposure and in a poor tax situation in retirement, right?
Yeah.
So why use it? Well, if you choose to self-direct some of that, put a piece of it in an IRA, self-directed IRA, which is another article I have on Forbes.
Yep.
If you choose to do that and you start investing now, early on, you'll see that basis grow at a much greater rate. Yeah. And you'll see investments in retirement that outpace your income.
Yeah.
And so that's why I think people should do it.
What does financial freedom mean to you? What everybody has their version. Like you got this medallion and you're like, yeah, I don't ever plan to actually stop working. So clearly your definition of financial freedom does not include not working. It clearly includes working. So tell me what financial freedom means to you.
I was just talking to a buddy of mine who's an investor in, I don't know, a dozen of my deals. He's director of finance for a REIT, and he invests in real estate syndications, not in his REIT. And so we were talking about working together, and he said, I said, hey, you have such a capacity and great reach to a whole diverse set of investment styles. How about we join together and maybe do a fund together? He goes, well, what would that look like? I was like, whatever we want it to look like. He's like, well, what are the expectations? It's like, whatever we want it to be. We have income. Whatever gets us excited to do when we get out of bed in the morning is what we should be doing. And he's just like, that to him was like, well, he's still plugged into the corporate world and struggling with what are the expectations? It's a new boss. It's this. I'm like, no. I said, when you wake up in the morning and if you're excited about doing something, let's just do that.
Right.
And if we can help each other out on that path, and it's really about just taking control over what you want to do and being able to be guided with what it is that is best for you, what it is best for your family. And to me, that's financial freedom. And my dad has 3 PhDs. My sister's a PhD tenure track professor at San Diego. Like I'm not like the highest educated in my family, but I come from a family of academics. I'll be working, I'll be trying things. I'm an engineer. I'm constantly tinkering. I'm constantly working on things. But it's that freedom that to be able to choose to do things that advances my family and myself and builds sort of fulfillment is what I consider to be financial freedom.
Again, another segment. I'm like, just pull that out. Like, what does financial freedom mean? Because so many people are like the American dream. Oh, it means I'm retired, I'm traveling, I'm playing golf. And there are a lot of investors, but that's not true. I ask this question a lot. There are a lot more investors who are like, the freedom over my time to do what brings me joy.
Mhm.
But I love the way that you said it, which is I get excited about getting out of bed in the morning because I'm doing what I love. And that doesn't mean I'm not working. It means I'm working in a way that I love to be working, where I'm looking forward to my work day. And I'm like, that's freaking brilliant.
Well, and that includes jumping on this call with you right now, Christina. So I was excited about this call.
Thank you. Yeah, I was excited too, because I've seen you over time. And then I saw you when Bronson invited you to the meeting. I'm like, oh my God, I haven't seen you in forever. Like I was able to put the pieces together. And so super cool. Patrick, how do people get a hold of you if they want to invest in your investments as a syndication? Because you educated us beautifully on what it means to be able to use a multi-unit syndications as a form of financial safety and freedom. How do people get a hold of you?
Yeah, so I have a website, investonmainstreet.com. And at the top, we always have, if we have a current offering, we do right now. We have one in Atlanta. And we have a webinar coming up tomorrow, actually. Well, I don't know when this is going to air, but
yeah, you're right, it won't be tomorrow. It won't be tomorrow when this airs, because it's not going to air today.
Got it. It's coming up soon. When you log onto this site, you'll see the investments that we have. Investonmainstreet.com, all spelled out. You can reach out to me at patrick@investonmainstreet.com. And if you go to contact on our website and you set up a meeting with us, I actually did a really fun project where I was wearing a wig. It was back when I had a little hair.
Yes.
And it's persistence, pivots, and game changers, turning challenges into opportunities. It did make an Amazon #1 bestseller.
Yes.
And through this book, there's Phil Collins, lead guitarist of Def Leppard. There's the real estate guys, Russell Gray, NFL, NBA coaches, entrepreneurs, and actors. And this was an amazing project, a lot of incredible stories. I'll give you a signed copy of this for free as a welcome gift for setting up an investor discovery introductory call with us, because I believe in this content and I love to share the stories. And it does tell my story. It involves our wedding in China. It tells about our when we moved to Hawaii. It tells about a lot of very interesting things. And I'd be happy to offer that to Christina's listeners.
Woohoo!
If you go to the website, set up an intro call, we'll have a chat and see if we're a good fit. Either way, I'll send you a copy of the book.
Thank you, Patrick. Patrick Grims, thank you so much for your time. Investonmainstreet.com. This is Christina Suter on Real Estate Breakthrough. We are on iTunes, iHeartRadio, Spotify, YouTube, Amazon TV, well, soon to be Amazon TV, and Roku TV. Come find our newest and best shows and our best guest speakers. Thank you, Patrick.
Thank you, Christina.